Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubanek, joined today by my good friend, Carlos Gonzalez Campo of Blockworks Research. Carlos, thank you as always for coming on the pod.
Thanks for having me. It's always fun, Jack.
It is always fun. And speaking of fun, Permissionless 4 is coming up. It's right around the corner. I am very excited. I'm, stalking the Luma pages, signing up for things. Want to encourage all of you to maybe grab a ticket if you haven't yet. Don't wait till the last second. It's not good etiquette. Carlos, are you going to be at Permissionless?
Yeah, I will be at Permissionless. Are you going to be in the dunk tank?
I've heard about the dunk tank. I guess I will be. I don't want to be the first guy in the dunk tank, but get a couple beers in me. Maybe I'll
Yeah,
I'll
I
walk
think it will
the
be.
plank. Yeah, because we have a combined 0x Lightspeed happy hour at Permissionless. The registration link just dropped. So would love to see some of you listeners. If you're coming to Permissionless, please come out to our happy hour. It'll be pretty happy. You can see me and Boccaccio fight each other in real life. Maybe chat with Carlos and I about some of the stuff we get into on this pod today. We always like chatting. Today we have a bit of a roundup episode for you. We're just going to be riffing on some of the big news events in Solana land and elsewhere from this week. I'm going to start today with something that I can brag about. Myself and my colleague Catherine Ross scooped this week that the SEC has asked prospective Solana ETF issuers to file amended S1 forms, which are basically like registration statements for these products to trade. That means obviously the SEC is actively engaging with Solana ETFs, and some estimates would say as soon as the end of this month or July, these ETFs could actually be approved. There's a couple other details involving staking and so forth, but I guess I'll just start out and ask Carlos, what was your first take seeing the ETF news?
I think it was unexpected by the market. I don't think it was particularly priced in. I think Sol ETFs could gather some demand that Ethereum ETFs have struggled to grab, just because Solana has a very clear storyline, if that makes sense. It's just like decentralized NASDAQ, whereas when ETH ETFs were released, there was no clear narrative around Ethereum, and the storyline was very complicated to explain, particularly to traditional investors who want something a little bit more simple. So I think with Solana, you have a very interesting principal asset that has a very attractive growth story. And then on top of that, if you enable staking for the ETFs, you have this predictable yield that almost makes it like a hybrid in TradFi terms between a tech stock and a bond. And I think that can be very attractive for traditional investors.
Yeah, I mean, you bring up Bitcoin, Ethereum ETFs and how Solana may have greater inflows. But even if it doesn't, even if these things trade about as well as Ethereum ETFs did, which a lot of people would say is not that well, that's a lot of inflows. I mean, I just pulled up the Blockworks ETF tracker here. There's 9.3 billion, and I think that might be an undercount even, but there's around 9 or 10 billion in AUM in these various Ethereum ETF funds. Bitcoin, obviously, something like 130 billion. So, 13x the size. But
yeah. And dollar for dollar, a dollar of ETF inflows is more impactful for Sol because it has a lower market cap, right? So yeah, when adjusted for market cap, it definitely it's significant.
Agreed. Yeah. Well, maybe we can just get into this now. I mean, do you foresee there being sizable ETF flows? I think that I sometimes wonder if the rabbit came out of the hat with Bitcoin and every asset thinks that an ETF trading is the key to riches and success, but maybe only Bitcoin can really pull sizable ETF flows. Boomers understand it. It's the oldest and most popular crypto asset by far. So do you actually foresee like these ETFs mattering a whole lot and gaining meaningful inflows from new investors and so forth?
Yeah. Yeah, I obviously don't expect it to be as successful as the Bitcoin ETFs. I don't think that can be replicated. I think it can have similar inflows to like ETH ETFs, and that, as you mentioned, like is significant for sold the asset just in terms of like buying pressure that you don't have like anywhere else, because you have like institutional investors, like, I don't know, family offices, hedge funds, whatever, that they can't invest in the asset via traditional like crypto exchanges, or like they can participate in DeFi, and like an ETF would be like the first way they can actually get exposure to solve the asset, right?
All the rage these days is these public crypto vehicles. Just this morning, I saw another 5 billion equity line for DeFi Dev Corp. So and those folks, which I have stated publicly, I have my reservations about this trend and what it is going to do to shareholders down the line. But these people would argue that it's a better way to get regulated exposure to SOL than ETFs are, because you can stake your whole balance. You don't have to. Arguably, there's maybe less commission on the staking, so just better yield that way. So, does the ascendance of public crypto vehicles kind of keep SOL ETFs from being as impactful?
That's a great question. I don't know. I kind of look at it like a micro strategy and like Bitcoin ETFs. I think there's room for both. Like if someone wants to get like exposure to these corporations that are investing their treasury into SOL, that's great, but it adds like an extra layer of risk. They can have like potentially, as you mentioned, like more rewards for taking on that risk. But at the end of the day, I think there are some investors who would prefer to just have exposure to the underlying asset without this added layer of risk.
Yeah, so this is kind of the thing, right? Is that the way that part of the way that you fund this Bitcoin yield or whatever that people are trying to replicate is by new investors coming in and buying up your equity, and so that can look a little unsustainable to some. And there's an argument to be made that the underlying crypto tokens might be okay, but some investors that purchase the equity from these treasury companies in like a severe drawdown or something could really see their shares decline really fast in value. You don't have the same risks with ETFs. So maybe pension funds or whatever would be more comfortable buying a Solana ETF than a Solana treasury vehicle, because it's just, if you assume that Solana isn't going to have like a huge negative blow up like this, then less risk, arguably.
Yeah, I would agree with that. There's definitely counterparty risk. You can also look at other comps, like for instance, in Europe. Like if you look at staking ETPs in Europe, Solana is very popular. I used to work at 21 Shares, which is one of the largest crypto ETP issuers in Europe. And in 21 Shares case, the SOL ETP is actually the largest product by AUM. It has almost like $1 billion in AUM, and it's larger even than the BTC ETP. A lot of it is like path dependency, I would argue, in the sense that you saw a lot of large inflows when SOL was below 100, maybe even below $80. So those inflows kind of compounded as the asset repriced to the upside in 2024. So I don't know if you can like actually replicate that model in the US, where you will see like incredibly successful SOL ETFs. But I think that their success in Europe definitely signals some demand from more institutional investors.
Solana's been hot lately, but you can truly never fade Bitcoin. Are you a Solana user who wants to get exposure to Bitcoin? Mint zenBTC to get that Bitcoin exposure with yield and some rewards to boot. zenBTC is the first application launched on Zenrock, a permissionless decentralized custody network backed by One Roundtable partners, 10T, Maven 11, and Spartan. Live on Jupiter, ROC is the native token for transactions within the Zenrock ecosystem and secures Zenrock's decentralized custody network. zenBTC is secured by Zenrock Decentralized Custody, and it ensures that Bitcoin holders can securely and seamlessly earn yield on their favorite chain, like Solana. Visit zenbtc.io to learn about earning yield with Bitcoin on Solana. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Yeah, good note, Carlos. It is over $1 billion. I actually don't know what it is today, but I remember being pretty surprised by that. It's the 21 shares Solana ETP is like top 5 in Europe, including Bitcoin products, obviously. The other interesting piece, I think, of the Solana ETF news was that basically the SEC came to these issuers and said, file your amended S1s, add in some language about how you would handle in-kind redemptions, which is kind of boilerplate. But the interesting piece to me was that they also said, if you plan to do staking, tell us how you're going to do staking in this amended S1. And my sense from talking to people is that the SEC is at least open to greenlighting staking as part of these funds when they're approved. Now, obviously, that depends on if the issuers come back and have some terrible kind of prospectus on how they would handle staking, maybe the SEC pulls the plug. But it's at least a conversation, which my sense was that wasn't always the case. Like that we might see something similar to what we've seen with Ether, where the Ethereum ETFs that were approved stripped out staking, and I believe still don't have staking enabled, to my knowledge. So this would be a big deal for Solana ETFs, especially with the staking APY. I guess the real yield from staking is something around like 4%, as Blockworks would measure it. But that's a big amount of potential rewards you'd be passing up on just to buy the kind of naked Solana ETF, and inflation obviously kind of dilutes you as well, if you're not staking.
Yeah, I mean, Lily Liu from the Solana Foundation, this was one of her core arguments when the whole CMD 228 drama happened. She was telling it's actually like from the perspective of the like institutional investor, like inflation is not like this bad thing, but it actually adds predictability to the yield. And a lot of this like traditional investors describe Solana to her as like a stock, but that's also like a bond, like this hybrid, and that made it like really attractive. And like many TradFi investors like actually value this predictability in the yield that you wouldn't have otherwise with this like very simple like inflation curve. So that's one thing. The other thing regarding staking is I hope that if they do approve the ETFs with staking, that they approve like an LST solution like Jito, because that would be like more operational. Like it would add a lot of operational efficiency to the ETFs. Like if you approve staking but don't approve like a liquid staking derivative like Jito Sol or whatever else, it adds a lot of operational complexity, and it will lead to lower APYs on the ETPs, because you have to consider like the utilization rate to be able to fulfill redemptions and that sort of thing. So like an LST would be much more efficient. And I think Jito has been like publicly in discussions with the SEC, and they have argued that Jito Sol is not a security. So I think if they approve it with staking, there's a good chance, in my opinion, that it goes along with like a Jito Sol ETP or something like that.
Do you buy that argument? Because yes, Jito has this liquid staking token, Jito Sol, which basically you buy the token and the rewards are baked into the price of the token over time, as opposed to that stake accruing to your account, I guess is how you could frame it. And Jito runs this piece of software called Tip Router, which autonomously decides how to distribute yield for Jito Sol. Sorry, I did not come prepared to explain all this. But And so because of this, Jito would argue that Jito Sol is the least security-like of really any liquid staking token, because there's no centralized entity that's distributing the staking rewards that could make it kind of be, fail the Howey test or something like this. And they also, I think, would argue that for tax reasons, because the rewards are baked into the token as opposed to sent to your account, it's more efficient to use a liquid staking token. But and they've put out a lot of content to this effect. But obviously, there's a lot of business upside for Jito if ETF issuers are using Jito Sol, or if you have like a Jito Sol ETF functionally. So basically, do you buy that argument? Does that make sense to you, or is it just kind of their way of trying to get this huge exposure to the huge inflows that would be unlocked by ETFs?
Yeah, I mean, it's a good question. Like, obviously, they benefit like from a business perspective, and it would be insanely bullish for Jito. At the same time, I do think like it's a win-win, right? It's not like they're screwing up the investors by enabling Jito Sol. On the contrary, it would be a lot more efficient to have like Jito Sol as the underlying and having baked in rewards than just using like a normal a normal validator to stake, because you have like this operational constraint where you can't stake all of the so let's say you have $100 in your like ETP, right, or ETF. So you cannot stake the $100 because you're going to have daily redemptions. Every day someone's going to redeem that, right? And you can't risk not being able to fulfill those redemptions. So what you do is you stake, let's say $50, so half of that. And then you leave like this $50 idle so that you can always like fulfill redemptions. With Jito Sol, what you can do is you can up the utilization rate slightly, so it leads to better APYs for the staking ETF, which is good for the investor, and it's obviously it's also good for Jito as a business. But like at the end of the day, I think it's a win-win situation for everyone.
Maybe to wrap this section, Carlos, like, let me just ask you a very, not helpful question, but a fun one for podcast content. So if we say that Ethereum so far has seen 10 billion in inflows in a year, I think, Bitcoin 130 billion in a year and a half, say 1 year. So let's say, for sake of the argument, Solana ETFs approved July 1st. On July 1st, 2026, what level of AUM in these Solana funds would you want to see to call that a success? Just based on the predictions you're giving about how popular these things might be.
Yeah, that's not a helpful question because I have no idea. But I'm gonna say like it surpasses Ethereum. I'm gonna go out on a limb and say it surpasses ETH. If it surpasses ETH inflows, it would be a success. I don't know the exact number though.
Okay, so above 10 bill, we'll call it.
Above 10 bill, we'll call it, yeah.
People vary on how optimistic they are on when these things are actually going to get approved, just even if you talk to issuers and so forth. The Bloomberg guys, I think, predicted July for approval for Solana ETFs. They know a lot of stuff, so maybe I'll defer to them, say look for these next month, but some people are less optimistic. So I don't know. It remains to be seen how soon they come. Carlos, I want to talk about CLOBs. Gross word, but there's been on Twitter lately a so-called CLOB narrative. Ansem tweeted people are under indexing on the CLOB wars and over indexing on the L1 wars. And I tweeted that this is a very astroturfed trend. I think it's like a few people that are interested in Hyperliquid or whatever that are basically tweeting about CLOBs and all the yap to earn slop that the industry or that crypto Twitter is filled with right now makes it seem like people are much more interested in CLOBs than they are. But I don't know. What do you maybe start out, Carlos, and just explain like what a CLOB is, how it compares to an AMM, and then maybe explain why you think people are interested in this right now.
Yeah. So a CLOB is basically just a central limit order book. So it's just an order book on chain. It differs from an AMM. An AMM is just like the usual like Uniswap type of thing that you had, like where you have just a constant product and people are trading against a pool that rebalances itself. Whereas with a central limit order book, think about like a centralized exchange like Binance, where you had like bid, that you had asks, and then it's a lot more efficient, right? The problem with central limit order books is that it has been very hard to pull off on chain, especially on generalized L1s. So for instance, Solana has seen some attempts at order books on chain. I'm thinking, for instance, about Phoenix, but they have been very unsuccessful, like in getting traction, just because there are some technical limitations on the Solana L1 that makes it very hard for a central limit order book to function. Another example is Zeta Markets. Zeta launched in May 2021, I want to say. So they are one of Solana's like OG protocols, and they have pivoted to building Bullet, which is an ultra low latency rollup that's like labeled as a network extension, and has gained like some narrative in the past like few days. So Hyperliquid, like going back to like the beginning of the topic, Hyperliquid is just like objectively the king when it comes to perps on chain today. So Hyperliquid does about 6 times more trading volume than all of Solana perps DEXs combined. We actually just released a Hyperliquid dashboard on our data product, so go check it out. But yeah, what I was going with this is that Hyperliquid is built on its own L1, and it has like a permission validator set that enables like structural advantages that make a central limit order book a lot more viable than on a generalized L1. For instance, on Solana, you can't really prioritize cancels over take orders. So on Solana, market makers have a structural disadvantage to toxic takers. And what that does is that market makers are not willing to provide as tight spreads as they would otherwise on Hyperliquid, for instance. So we've seen like this like narrative of like other attempts at central limit order books, like built on rollups, like network extensions or whatnot, that can replicate Hyperliquid success. So at the end of the day, I think like people are chasing hype beta, and that's what you have seen on SAX, for instance, which has gone up like 5x in the past week. I do think like it's very interesting, and that it's definitely worth experimenting. I just don't know like how much of it is hype versus if they can really pull it off and disrupt like Hyperliquid, right? You also have like other examples. For instance, Fogo is building its own like SBM chain that's going to be based on a pure fire dancer client, and they are doing like collocated validators to like optimize for this type of financial applications. The Ellipsis Labs teams is also developing Atlas, which is an L2 that's also optimized for financial applications. So I think like you're definitely seeing this trend of people saying like on-chain order books are not really viable in that generalized L1 like Solana. So let's like go ahead and build it like our own rollup, our own chain, like that's optimized specifically for this use case. And that's the narrative you're seeing like these days, even though many of these developments happened like months ago. Like Bullet was known like since late last year, but people are just paying attention now.
To put it briefly, would you just say that the benefit of AMMs or of CLOBs over AMMs, which is what a lot of like Ethereum DEXs run on, is that whereas in an AMM you passively like reactively provide liquidity when you get a buy order, a central limit order book would just match bids and asks at the best possible price, and so you're not like getting picked off with stale prices basically that AMMs provide.
Yeah, exactly. Like on-chain order books are basically more sophisticated if you want to look at it that way. Like AMMs were great at the beginning of DeFi when like you didn't really have like sophisticated participants and you needed a way to bootstrap liquidity. So AMMs are really good at bootstrapping liquidity and are really good to handle liquidity for long tail assets like new meme coins because market makers will never really attempt to take on this vertical because it's too risky for them. So for new assets, for long tail assets, AMMs like remain the most efficient way to handle the liquidity, and that's why they will never go away. Like things like Radiant, things like PumpSwap, they will always exist for like a new meme coins that come to market, and that remains like the most efficient way to bootstrap liquidity for these assets. But when you look at highly liquid markets, on-chain order books are definitely the most efficient way to trade these assets because market makers can actively quote based on like sub millisecond or millisecond like latencies, right? So what we're seeing is this trend of passive liquidity provision being phased out by more active market making. And what you're seeing is like attempts to pull that off on chain. And I think like that is actually a core focus for Solana core developers today. Like, how do we make this a reality that can be achieved like on the Solana L1 today? And that's why you're seeing a lot of talks about like multiple concurrent leaders. Like, how do we prioritize cancels over takes? How do we enable application specific sequencing? Because this is necessary to make CLOBs a reality on Solana today.
Solana's been hot lately, but you can truly never fade Bitcoin. Are you a Solana user who wants to get exposure to Bitcoin? Mint zenBTC to get that Bitcoin exposure with yield and some rewards to boot. zenBTC is the first application launched on Zenrock, a permissionless decentralized custody network backed by One Roundtable partners, 10T, Maven 11, and Spartan. Live on Jupiter, ROC is the native token for transactions within the Zenrock ecosystem and secures Zenrock's decentralized custody network. zenBTC is secured by Zenrock Decentralized Custody, and it ensures that Bitcoin holders can securely and seamlessly earn yield on their favorite chain, like Solana. Visit zenbtc.io to learn about earning yield with Bitcoin on Solana. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. So, perps are basically just gambling, right? Like, there's some serious traders maybe use them, but like kind of the benefit to my, now I don't trade perps, but to my knowledge, the real benefit of perps is that you can, place a bet on if BTC is going to go up and become James Wynn and have like a $1.2 billion position at some point or whatever. And there's like this casino gambling aspect to it. So with that in mind, something I've been thinking about is why doesn't Pump Fund build this? Like, why doesn't, if Hyperliquid is not necessarily a competitor, but just one of the most popular products alongside Pump right now. But Pump is about to raise $1 billion reportedly via an ICO. Like, what's to prevent them from, say, acquiring Bullet or Drift and then building like the Pumper Liquid, and then you own meme coins and you own perps, assuming you could outperform Hyperliquid. I don't know if that's. I know it's a very, technically savvy team.
Yeah, I think it's very different, like business models, right? Like I look at Palm more like as a consumer product almost, where you have like this very high turnover of meme coins, and the majority of the volume that you see on like Pump or Radium is actually from assets that were created in the past, like I don't know, 30 days or so. So I was looking at Radium stats the other day, and if you look at Radium's overall volume, like almost 70% of Radium's volume comes from pools that were created in the past like 30 days. So it's like very new assets. It's like chasing, like being early to the next meme coin and so on and so forth. And for that, like perps doesn't really make sense in my opinion. It's just like that to me is more like gambling, right? And as I was mentioning earlier, AMMs are a lot more efficient in handling the liquidity for these assets. For perps, you see a lot of the volume come from the majors. So I haven't looked at Hyperliquid data like in the past, like very recently. But last time I checked, the majority of the volume of Hyperliquid comes from L1s. Like you can see Bitcoin, Ethereum, Hype, Sol. So it's like a very different like trader profile, and you have like active market makers engaging in the quoting of these assets, whereas you wouldn't have like market makers quoting a meme coin that is one day old, right? Maybe you would do for like high profile launches like the Trump meme coin, but for most meme coins, it's not really possible. So I think they're really two separate like business models. Like maybe Pump like tries to do that. Like if they raise $1 billion, that is a lot of money, and they can try to expand like their product offering. But I don't think like for their core business it makes sense to add like perps.
Yeah, it may almost be that like Binance or one of the big sexes is a better contender to try to build a viable Hyperliquid competitor, because I know that Hyperliquid is no KYC. Binance does have KYC checks, and so that might be a benefit to some traders. Certainly, people I know don't like to have to go through the whole KYC process to start, placing those perp bets. So maybe Pump isn't the best potential candidate here, and it's probably sexes that have more to lose and gain from trying to compete in that field.
Yeah, I mean, definitely. Like, when I think about Hyperliquid, like main competitors, like it's definitely centralized exchanges are on the top of the list, and you have seen Hyperliquid take some volume, like from Binance. Binance has a perps product, by the way, and yeah, some people argue that the only reason traders are using Hyperliquid is just the reason you mentioned, because they offer no KYC. I actually think that's like undermining like what they had pulled off. I think they have like a great product, and that's why people are using them. Although you cannot deny that the no KYC thing is also like a value add for some people.
You mentioned a second ago Radium, and Carlos, you write a fantastic monthly report on Solana every month, and people should check it out. We actually have a print copy at the office because Drift for their DeFi Day printed some out. So, I just peruse that like a magazine now and again, the April Solana report or whatever. But I digress. The most recent one, you pointed out something I found interesting, which is that, I guess, quoting you here, regarding DEX dominance, Radium's market share has decreased from almost 60% at the beginning of the year to 35% as of today. I just want to get maybe like a vibe check on Radium, because I know that for a long time they were, the unofficial partner with Pump Fund for token graduations. They made as much more revenue sometimes than Pump Fund throughout much of 2024, but then obviously Pump Fund launched its own AMM Pump Swap, cut out Radium. Radium launches its own meme coin platform, but clearly that hasn't been able to prevent a loss of market share for them. So what's your outlook on Radium right now? Like, are you bullish on Launch Lab and its ability to kind of bring Pump users into Radium? Is there a different outlook or way that they should be thinking about growth going forward?
Yeah, I mean, like when you look at Radium's volume composition, 80% of their volume comes from meme coins, right? So we knew in February when Pump announced they were going to phase out Radium graduations for their own AMM Pump Swap, that it was going to be bearish their volumes in some way or another, because they were losing the largest source at the time of new trading volume. As I mentioned earlier, like for Radium specifically, because they're so reliant on meme coins, new trading volume is the most important thing. About like 2/3 of their volume comes from pools that are less than 30 days old. So what they did is they launched Launch Lab to compete with Radium. And what we're seeing is just this trend of like these types of protocols trying to own the end user. I think Mark from the Blockworks research team put out a great tweet the other day that says, own the user, own the flow. And that resonates a lot with me. Like what's most valuable here is just owning the front end and like owning the entire user flow to like redirect volume to your exchange, right? Pump has been very successful at that. Radium is doing some interesting things. They have been partnering with other like ecosystem players. For instance, I'm thinking about Bonk, which like is using Launch Lab in the back end for their like launchpad product. I don't think it has been as successful as Pump, and they're kind of struggling to gain market share in that regard. But they're an OG DeFi protocol in the Solana ecosystem. The revenues are very strong still, so I think like they can like survive and try to compete in that vertical. But definitely, Pump has a big lead when it comes to like launch pads.
Is Radium harmed by the kind of movement away from AMMs to more of these like professionalized proprietary market makers? Because I know that the DEX runs on an AMM. So are they getting less flow from like Jupiter and stuff like that?
Yeah, that's kind of what I was going to mention. I think what you're seeing in the Solana DEX landscape is a bifurcation of DEX dominance, like based on asset type. So on the one hand, I think like AMMs like Radium and PumpSwap will continue to dominate long tail asset volumes, such as new meme coins. I don't think anyone's taking away that from them. On the other hand, for highly liquid markets like the Sol USD pair or stable to stable, like it trades, what you're seeing is an increased flow of volume go to prop AMMs like SolFi. I don't know if I think we've talked about them in your pod, but basically this function very like similarly to like they're not an order book, but they're like Oracle based AMMs where liquidity is protocol owned. So you don't have like any external LPs and you're able to like quote like assets very quickly and provide like the best price execution. So what you're seeing like from the aggregator side is that you're seeing something very interesting actually. Like if you look at SolFi, like about 80% of their volumes comes from aggregators. And what that tells you is that they're providing the best price execution, and aggregators are constantly routing through them for these types of like trades, like Sol USD stable to stable. When you look at Radium and Pump, like the percentage of the volume that comes from aggregators is very low. It's like 20% or something. Like most of their volume comes either directly from their DEX, so people hitting their program directly, or people interacting through a Telegram trading bot or like a trading platform like Axiom. So it signals like very different like trading profiles. And for these, like for Radium and Pump, what's more important is like just owning the end user and providing like this constant like turnover, like new meme coins, like new things to trade, because that's at the end of the day what makes up like 80+% of their volumes.
Last thing I want to ask you about, Carlos, it's switching gears. There's no good segue here. I'm just gonna dive in here, but I wanted to touch briefly on stablecoins in light of the Circle IPO. Incredibly successful, kind of blockbuster electric factory of an IPO. Price went up a ton, seemingly because investors are very convinced, at least this is my reading of it, is that investors are convinced that stablecoins are the breakout product of crypto right now, but there's obviously not a lot of good ways to get direct financial exposure to the stablecoin sector, but the Circle IPO is a pretty good one. So it seems like that's why it outperformed so wildly. And who knows how long the IPO window may stay open. That, you know, it's hard to predict these things, as Circle itself learned years ago. I guess I just want to ask Carlos, with this IPO going so well and so much buy-in from BlackRock and, you know, the Cathie Wood one, ARK, and just all sorts of like major financial institutions, has Circle won, at least in the US? Like we talk a lot about what it might take for USDG or some of these other alternative stablecoins coming out to peel market share away from Circle, but Circle dominates, you know, over 70% of all stablecoin supply on Solana. with this IPO having gone well, are institutions going to start like integrating the thing, learning how to work with Circle and its all its backend tech, and is that just going to create an insurmountable lead for other stablecoins, at least in the US?
Yeah, I mean, two things. I think like definitely what we've seen is that centralized issuers are getting an insurmountable lead over decentralized issuers. And like that's what you're seeing with regulation as well. I think like the latest stablecoin bill favors centralized issuers like Circle over decentralized issuers like, I don't know, like Sky, Athena, or whatever it may be. So in that sense, like, yes, like centralized issuers are better. Is Circle developing an unsurmountable lead on other issuers like Tether? I'm not sure. I think Tether still has the ability to maintain its lead over Circle. Maybe Circle or USDC will be favored like for US entities, but I think globally Tether will maintain like its dominance for USDT. I do think like USDC's network effects will be hard to disrupt, like in the US specifically, but I think like the incentives are there for other players to launch their own stables because they have seen how profitable it can be. So you have seen like USDG, but I also think banks will eventually like launch their own stables and try to compete with Circle, because it just doesn't make sense that they just let them take away the entire market. I think you'll see competition, and I think you'll see stronger players like banks release their own stables and try to like take market share in that sense. One last thing I would say is like regarding like the Circle IPO, why it has performed so well. I think like for so long, people had this question of how do I get like exposure to stablecoins? Like I know coming out of that's the one question people were asking, like, how do I get exposure to like stablecoin growth, right? And I think like Circle is one of like the purest ways like people have found or investors have found to just get exposure to the stablecoin meta, because our answers previously were just like incrementally like money markets benefit, yield trading marketplaces like Pendle. But like Circle is just like this direct way to get exposure to stablecoins, and you kind of don't have that anywhere else in the market. So I think it's one of the reasons they have done so well. You have also seen like the plasma race like recently with Chapman, like it filled like the 500 million within like 1 minute, and I think it just speaks to like investors desire.
Didn't it do a second round too?
It did a second round, yeah. It raised it to 1 billion, yeah.
Crazy.
Yeah,
pretty frothy out there right now. But yeah, it's like anything you can do to, maybe that's even why we're getting these stablecoin chains. So I guess Plasma would sort of be one, but it's like anything I can do to get access to this narrative other than just holding dollars. I don't know. Like there's no real good way to get access to stablecoins. So agreed. With that, have you gotten out all your thoughts on stablecoins, Carlos? I don't want to.
Yeah, sorry about the last minute thought.
Yeah, thank you for doing an episode.
No, thanks for having me. It was fun.
Thank you, everyone. If you have made it this far, if you're still listening, please like 5-star wherever you get your podcasts. Subscribe to us on YouTube, Spotify, Apple, all that good stuff. If you enjoyed this episode, we'd love if you shared it with a friend. And we will see you again very, very soon.